Hi guys, this is Kearns and this is lesson 9. We are getting into real deal now. We are getting very close to some very difficult subject. I think that we are not even halfway in the curriculum. I'm not sure. Yes, I think we are not even halfway, but we get in there. So this lesson is about trends. Now I think that we just cover time frames. Now we're gonna talk about trends. Now, trends is so important for swings. This is probably one of the subject that you'll have to go over and over and over. Okay, that's a disclaimer for the entire class. Actually, and then now let's start with a quote. It does not matter how slowly you go as long as you do not stop. This is from Confucius. Now, don't go too slowly. That's what differs a swing trader from an investor. That's my only comment. Yes, you have to make sure you are conservative, but sometimes in life you just need to push a little bit on the risk button, but it's always pay up. It will pace down the road to be patient. So as a swing trader, patience is extremely important. Make sure you keep going and stick to your strategy. Just don't stop. Okay. Now, if you just start, remember the first 2 years are all about surviving, and then you'll probably spend another year recovering because you'll have to fix the losses, and after that you'll become profitable, and then you'll break even. And the rest really depends on you. But keep going, you'll make it there. Everybody has the potential to be a good trader. Maybe swing trading is not your thing, but even though you have the type of personality for day trading or scalping, honestly, it's always be recommended to start swing trade or investing. Once you get you get control, you go over some very important concept, maybe you'll go ahead and then put some money at risk and build up your experiences. Now, let's talk about trend. The trend is the expression of which side is in control in the market. Now, I already told you that the market basically is a big war. It's a big war between the bulls and the bears. In any wars are divided. Wars are divided in many battles. So I'm gonna try to give you an example. Wars. Okay, so it's a war between the bulls and the bear. We have a big war between the bulls and the bears. Did not use the specific color, but that's okay. And the wars are divided in battle. You know that war are divided in battles, many battles. And then what happened after the war, it's the result of the many battles. Let's say that we have like a sets of 5 different battles. You have a battle A, B, C, D, E, and then if so, I'm gonna use a little bit of A, B, C, D, E. Let's say that the bulls win this one, this one, this one, and this one, and the bears, they manage to win this one. So you'll judge by the color. When you go over this, you'll realize as a result, even though the bears did manage to win battle B, in overall, this right there, overall this is a bull trend. overall this is a bull trend because you have more, the bulls manage to win more battle than the bear. Okay, now this is the same case if, for an example, you had same scenarios in many different battle, but in this situation, second scenario is the bears win, and then let's say that you had two bulls. The wolves managed to win 2 battles out of 5, and the bears, they managed to win 3 battles out of 5. So in general, the bear win the war. It's nothing different in the wheel market, because when you consider the market, what happened is the market is generally ruled by 2 forces, and then those 2 forces generally they create 3 type of trend. So you have a bull trend in situation the market is going up. You have a sideways market situation in which the market is going in that direction, and then you have a bear trend. Now they can appear in any given order, so you can have bull, it can literally be something like this, an uptrend, a downtrend, sideways. The order is not really important. It can literally be in any given order. Now what is the most important thing is that whether we are in a bull trend, sideways, or a bear market, what happened is we have a set of different type of moment, and this can be considered as different battle in the same war. It's the same thing here, same thing here, you know. So this type of battle, or for an example, in a bull market, you have more win from the bulls, and here in a bear trend you have more wins from the bears, and here they have kind of equal win battle. It's like none of them are really in control of the trend. So technically, just to give you another clear example, more clear example, if we are analyzing a bear trend, something like that, there is a lot of uptrend, and like this, and then certainly there is some moment when the bear wins. These are the moment in which the bears manage to win, but in general, the bulls, they have more wins, and because of that the price keep going up. Now the same thing in case you have a bear market like this, the market is bearish, so you certainly have movement like this and like this. I am making them very simple, like you might have a small rally, well this might be considered as a sideways, for an example, inside of a bear market, and then you have a small rally like that, you know, and then maybe you have a sideways market here, and maybe, you know, another movement. Now these drops, generally they call them sell-off, they call them dump, okay, they call them drop, generally literally mean the same thing, okay. And these movement, you know, I already talk about that, these are bull rallies, okay. Now in a bear market you have to behave differently, in a bull market you have to behave differently. Now let's go over them real quick and I'll explain them to you. Now like I told you, three trends essentially: bull trend, bear trend, or sideways. Now the bull trends is a situation in which you have bulls are in control. It consists of a series of higher highs and higher lows on the chart candlestick. Okay, buyers keep increasing their bids. Okay, now remember what I told you about the bids. Bids are the price in which bids the bulls are ready to buy. Someone came, he bought at 100, another one is ready to buy 100.5, 100.6. now they are increasing the bids and the price is going up. Now you don't need a college degree to realize this is a bull trend, right? You don't need to be too complicated in order to understand that. Now there's another see these are lows, another lows, a low, another one here. But what you can realize is that these are higher lows, so the lows are higher and higher and higher. Same thing for the highs, higher highs. See these? I'm gonna take this instead. Let me remove that. Okay, let me remove that. That's a higher high, higher high. We can take that and eventually this one. Now in our in the trading world, they call this movement swings, so they call them swings, and these are very important for you because as a swing trader, see those swings, these represent opportunity for you. For an example, enter here, get out here, enter here. Now you are enjoying the swings. In a bull market you behave in a certain way, in a bear market you behave in a different way. But what is the most important is you will realize that this high right there is lower than this high right there, and it's lower than this high right there, and this one and this one. Same thing for the lows. This low is lower than this one and lower than this one here and here. Now this is the technical definition of an uptrend: higher highs and higher lows. Okay, let's try to see if I get another. Okay, that's another example in which you have a clear uptrend. The chart does not need to be extremely complicated to realize that. So you have a swing right here might be considered as one. Let's see what this one, a swing, another swing, and then here, and probably another one here. Now you don't need, like I told you, a college degree to realize this low is lower than the one here. This low, that's a low, is higher than this one. This low is higher than this one. This low is higher than the previous one, and so on and so forth. And same thing for the highs. This high is lower than this high, and you see this one, this is clear and simple, higher than the previous high, and this is probably gonna be a swing, and this swing is higher than this one. And these zones, they are called swings. Once again, they are extremely important for us. This type of movement in the market gives the name to the type of trading style we are using, which is the swing trading style. Okay, now you heard people talk about swing high and then swing low. We're gonna explain that down the road. We don't have to put too much concept in just one lesson or just one video. Okay, so this is technically the definition of an uptrend. Now, bear trend or downtrend, we call them downtrend too. It's the situation in which bears are in control. It consists of a series of lower high and lower lows. Okay, the asks keep going lower and low and lower. So if I have to do a quick explanation, the explanation is that the bears for some reason they enter in control in the market, which means they are selling a lot. And what they are doing is that, you know, that when you post a sell order in the market, this is a ask. You are asking a certain price for your asset, your coin, or your stock. Now, because the bear market is a situation in which prices are going down, what is happening is that, like I told you, bears are winning the war. Because they're eventually winning more significant battle, we can say, and they keep asking lower and lower price. So if, for an example, LTC was $100, so someone else might come and ask 99.9, 99.5, 96, 0.1, 95, 94, and this movement right there create that bear pressure. And then because the ask keep going lower and lower and lower and lower, so in general the price in general is going down, because all those bear, they're selling because price is going down. All right, so here, these are very simple way to just analyze a bear market. It's pretty clear. You can just go ahead and see it. Gonna go ahead and look deeper. Now, all these are daily time frames, so it's very important for you to realize that we can keep that, because this part of the chart is more sideways. We are trading in a range, but here is clearly a downtrend. So can you see these are getting lower and lower? Now that was a clear downtrend. This zone right there was a little bit sideways, and probably another drop here, which you have a swing here and one here and another one probably gonna happen here. Now what you need to see, take a look at this. This is probably a swing, so take a look at this. That's a high right there. This high is lower than the previous high. This high is lower than this one, and so on and so forth. Same thing for the lows, because you know what, in the swing trading, and I'll tell you that you need to consider the close, the bodies. Do not include the wicks in this particular type of strategies. I'm gonna tell you why. We're gonna give you more detail down the road. This is a lower low and another lower low, and here we are going down. So in general, the bears are winning. That's a clear bear market, because the ask keep going down and down and down. Now here, that's another movement, just illustration for bear market. Here it's a swing. Okay, this is another one and another one here. Swing, another swing here. Okay, you can clearly see these big swings and so on and so forth. Now what is important, you can go ahead and pay attention to the fact that these highs are getting lower and lower and lower, than the other one. Same thing for the lows. they are getting lower and lower, and so on and so forth. Now this is the daily time frame, and every example we use so far are daily time frames. If we go a little bit deeper in the chart, let's say that we go a little bit lower in time frame, let's say that we switch to 4-hour time frame, there's nothing different. You're gonna have a situation in which you're gonna have a clear downtrend or a clear uptrend or a sideways movement. It's extremely important to be able to identify them properly in order to make sure that you're not trading against the trend, because like I told you, when it comes to swing trend, it's not just the friend. I mean, you're probably familiar to the fact that everybody's telling you that trend is your friend. When it comes to swing trader, that's the only thing we know. It's not just our friend, it's our God. Okay, so our trading God. Okay, and then after that, the next one is the sideways market. Now there is a lot of discussion about sideways, because some traders consider it as a trend, some others do not consider it as a real trend. That's the reason why if you're probably gonna read different type of book in which they're gonna consider the sideways as a continuation. But some other trading school, if you can say it, they say that, well, sideways doesn't mean that the market gonna keep going. Some traders, they do not consider sideways as a real trend. It's like I told you, they are talking about continuation. For an example, you might have a downtrend, and at a certain moment the market become sideways, so it's being traded in a range, and then it keeps going down. Now these traders, they say this is not a specific trend. They consider this as a zone of consolidation. They might call it a concentration zone, but they essentially talk about continuation. But not every traders are okay with that, because for an example, I'll give you another example. You might have a bull market in which market is going up, and then certainly we are trading within a range, and then it keeps going up. Now the reason why I personally teach it as specific trend is because of the fact that nothing is certain in the market. This doesn't mean that because it's a bull market, we are about to keep going up. The market can perfectly do whatever it wants, so we can perfectly be moving like that, keep going up, and then right away we enter a bear market. Same thing for a bear movement. We can keep dropping, and then we have this sideways movement, there's no continuation, and then we keep going up. Now because this type of the probability is very low, and I'll give you that, because so often, for an example, in the bear market, what you're gonna have is a movement in which the market gonna test a certain level. We're gonna call it a support, because the lesson about support is a few, like 2-3 lesson after this one, and then we're gonna bounce off of it and then eventually keep going down. Now the probability of going down is always around 80 to 85%. So 80 to 85%. That's the reason why some traders consider this as a continuation, not a proper trend. But because of the fact that nothing is certain in the market, and this is a concept that you must always put in your mind in order to make sure that you do not start trading like it's an obsession, that's gonna drop. You probably heard that, or that's gonna break up. There's no such a thing in the market. Now it's better for you to consider this as a proper trend, okay? But when we're gonna do our trend studies, you will realize that generally we only talk about bull or bear trend. there's not a really proper way to do a sideways trend study. It's not always clear, but for the purpose of learning, which is, it's better for you to consider this as another type of trend. Now, the other reason why I want you to understand, to learn this as a different type of trend, there is a question of trading strategies. Now, this is extremely important, what I'm gonna tell you. Generally, a trader, I think I'll talk about that in a few slides coming. Generally, a trade strategy doesn't work in all the market, because the market trends are governed by different type of emotion. Let's go ahead and do another board. Now, told you have a bull trend, you have bear trend, and then you have your sideways. Remember, for the purpose of learning, consider sideways as a trend. Now, what happened is that these trends are governed by different type of emotion. This is essentially governed by greed. A bear market is essentially governed by fear. And a sideways market is essentially governed by indecisiveness. There you go. Okay, different type of emotion, different type of result, and different type of presentation on the chart. All right, now generally a trading strategy, I personally don't know any trading strategy that works in all the different trends. So often you'll have to go ahead and build different type of trading strategy for different type of trend, and they must be you must write them down, and they must be very clear in your mind. So in a sideways market, no side are clearly in control. Markets generally spend a lot of time in sideways. A sideways market can be very long and very boring. Trades are made in specific ranges. Most well-known trading strategy will fail to perform and or show many losses in sideways. This is important. You need to keep that in mind, because you're gonna see that when we're gonna study the strategies. And sideways market are probably the moment in which scalpers make more money than any other type of trading strategy. The reason is because we are being traded in a trend, in a range. I'll show you. That's the first example. Because we are trade in a range, it's very difficult to make like 20-30% a year, because you might take a long, because what happened is that you'll have to wait. For an example, look at, you remember this candle right there? For example, you might see this candle, these candles, and then some sets of signal, and then the thing is that you will probably not be able to buy at the very bottom. So you'll probably enter somewhere here, and then what happened is that we are back in this range, and then the market is not really volatile. It's a bunch of indecisiveness, and you got yourself locked here. The reality is there's a very few trading strategies that survive in sideways market, and this is probably the moment in which scalpers, they make a lot of money, because they have trained themselves to trade in small time frames. We are talking about, man, that thing is cool. We are talking about 1 minute, 5 minutes. So this type of traders, they manage to be profitable here, because an entire trading style might not be profitable in a sideways market, because these guys, they're looking for that 1 to 2% gain per trade, and it's perfectly possible to do that here, and with a lot of security. They generally, this is the scalpers heaven. They are safe in sideways market until something terrible, a break up or breakdown happen. But generally, good scalpers, they know how to get out of it without big losses. So this is clearly a market in which that's the range right there, you know. So scalpers, they are enjoying everything here. Everybody's getting luck, but they keep making money in sideways. This is probably one of the trading style that manage really to be profitable in sideways market. Okay, what next? That's another example of a sideways market. Okay, so here that's more clear than the other one. So you can clearly see that here we are being traded in this particular range. Oh man, that's terrible. Here, that's a range. See this range here, that's scalpers heaven, you know. They here defending their 1 to 2% per trade, and they have on some scalpers, they even go lower than that. They literally fight for that 0.5% to 2% per trade. And we are talking about people that easily they take up to 10 to 20 trades, you know, per day. And because of the fact that crypto trading in the cryptocurrency market is 24 hours 7 days a week, so they keep trading non-stop. And so often those type of trading style, they spend a lot of time in front of a screen. Technically they're slave at home, I can say. Okay, or it really depends on their account, you know, really. So okay, so remember in the beginning of this video I was talking about the fact that is a trend is made of many battle. So we're gonna change the word battle, and we're gonna talk about wave. Now, talking about Elliott wave, we're not gonna go into detail right now. Okay, but I'm just gonna make a simple presentation about it. Now, often a trader will need to readjust his strategy or literally build 3 different strategies in order to be profitable in all the 3 trends. Now, this is very important for some beginners, because sometimes you go ahead and you read a book, you get a video, you find it on YouTube or whatever. Sometimes you even pay for a small 2-3 hour class, and then they present to one particular strategy. Now, this strategy works. It works on just one trend, and here you are, the market got locked in a sideways market, or the market got locked, or the market get a reversal in exchange, and or worse, that person who teach you that particular strategy didn't tell you when to expect for reversal. Now, what happened is, so often a beginner might get frustrated. A trading strategy that used to work suddenly doesn't work at all. Now, we saw that often in trading bots. So often trading bots developers, when they build a bot and with a couple of strategies, so often this bot can only trade in one trend. So when the market change direction, the bot that you pay a lot of money to get generally became totally obsolete, totally useless. It's because the reality is different trend must be aboard using different strategies, and that's your bull strategy, your sideways strategy, and your bear strategy. They must be clear in your head, and you must write them down on a paper. I literally have 3 printed paper, stick them on the wall, because I know when I'm a bull trend, I'm gonna use this strategy, and bear trend, sideways, same thing. I am clear about that. Now, let's talk about the concept of wave. here, just before we go ahead and look at this chart, the market doesn't make any kind of move straight, and I already told you that the market doesn't make a move like that all the way down or straight up, you know, or stay straight line, which is sideways. It's very important for you to make sure that you keep this color. I'm gonna use the same color just for the purposing of educating you. Now, what you need to understand is that whether we are in a bull trend or whether we are in a bear trend, the market move in wave. So I am gonna start by presenting you the concept of Elliott wave, but I'm gonna be extremely simple. Elliott wave, not sure if I write down the Elliott waves. Okay, so we are in an uptrend, right? So the market have a sets of push and a sets of ease. So the market is going in an uptrend. You have 1, 2, and 3. Now that's a pretty simple way to represent Elliott waves. There is a set of principle about it, and we'll probably have to talk about it in a part 2, very late in the part 2 or 3. But what you need to understand is that the market is moving based on different kind of waves. And previously I talked about different battles, but we're not gonna use the word battles. We're gonna talk about waves. And these waves, you know, for an example, in an uptrend you have a rally. Generally rallies are consist of 5 waves like this. 1, 2, 3, 4, 5. And generally, in a very simple case, after 5 waves, the market enter what we call a correction, and you have a correction that is generally 1, 2, 3 waves. Generally they talk about ABC correction type. Now this is the most simple market moves. Elliott waves are extremely complicated, and honestly, if you're not a day trader, you don't really need to master that thing, because you're not gonna enter here. Generally swing traders, we enter somewhere here, you know, and write that thing up. We saw that first correctional wave, we get out somewhere over here. So it's very important for you to understand this concept. Now this simple move is the bull rally. Okay, this is physician are terrible waters. So this is the rally right there. Now this is not a bear rally, because I told you that was a bull trend. This is a correction. Okay, this is a correction, or they call retracement. Okay, so in a bull trend, this is another one. I'm sorry, this is a set of a bull rally, a correction, and this entire thing right there composed of many different waves. You have 5 waves up, and 1, 2, 3 waves down, and then the result of that particular scenario in the market is that we're gonna have another wave, another sets of wave, probably like that, 1, 2, 3, 4, something like that. But what is the most important thing is you're gonna realize that this low right there and this low right there, these are lows. These are lows. And these are swings. And you can see the swings. This low is higher than this low. That's the reason why this is a probable bull market. What is important is that the concept of wave, you'll realize that a wave consists of different waves. And then what happening is that in that same situation, in that same scenario, you might have a 1, 2, 3, 4, 5 wave, you know, and then a correction like that. Hey, oh man, a bunch of small correction. What is going on with that thing? A, B, C. Now these are correction, A, B, C's, and then this, my friend. Okay, 1, 2, 3, 4, 5. A, B, C is the same thing in this direction. So we're not gonna go into very detail this behavior. They call it a fractal behavior because every single wave there's wave. So in conclusion, you have a wave, and then in this wave you have a bunch of stuff like that, and then you have this. Just to make it simple. Oh man, what's wrong with that thing? Okay, just to make it simple, and then same thing here. Bunch of waves, tiny waves, you know, bunch of tiny waves, and that's how you should see. That's how you should understand the market. These are a bunch of tiny waves, probably something like that, you know, and then you have a bunch of tiny corrections like this, and this entire thing might be part of another bigger wave that is going this way. And that's exactly how you should understand the market. And that's the reason why the short presentation really changed from time frames to another. Now this is an introduction about Elliott wave, because I don't want to get into real detail, but the concept of wave is extremely important for the purposing of swing trading, because swings are extremely important. They give us an idea about a probable reversal. A reversal is when a trend is about to switch to another trend. Okay, so these are important for us. Now here you can go ahead and, without further explanation, you can clearly realize that we got different waves. I mean, look at these ones. We're not gonna get into Elliott wave details. I'm gonna let that for Elliott wave specialists, because the thing is, honestly, I just know a few simple principle. I'm gonna teach you a few simple principle about Elliott wave, but I'm not gonna get into details. I might find you a better a good book so that you can go ahead and do your own researches, you know. And then, so in order to study the trend, most swing traders use indicators, but the truth is you don't really need indicators to just go ahead and look at the chart and realize that, well, we are in this trend or that trend. You just need to look at the swings. Okay, you just need to look at the swings. And remember when I was talking about time frames, when I told you that the bigger the time frame, the more important a technical analysis. So a swing in a big time frame is extremely important. You got to swing in 1 week. This is extremely important. you got a swing high or swing low. Bigger time frame, if you have a set of higher highs and higher lows, you almost guaranteed is an uptrend. Okay, because the swings they do not happen very often. In I'm gonna try to get you an example, and I'm gonna use a time frame that we use rarely. That's a weekly time frame. Okay, so we're gonna use the monthly time frame. See, that's Bitcoin US dollar. See, there's a very few swings, or or we're gonna say very rare highs and lows. And so when you look at that, I mean, that's just 1 year. Honestly, that's just five swings, and then from 2012 to 2019, that's 7 years. So the bigger time frames, big time frames, they don't have a lot of important swings. So when you see them happen, they are extremely important because they are rare, actually. Same thing for that daily time frame chart. You don't need a bunch of indicators to realize that you have lower highs, they are clear, or even there higher highs. You don't need a bunch of extreme complicated stuff to realize that. Now, why should I never short? It's because I'm seeing higher highs, yes, but you can see higher highs in 5 minutes. You can literally see higher highs. But why is that it's so important? It's because it's because you spotted, you saw it in the daily time frames. That's just the difference. So when, as a swing trader, you saw those big important pattern in 1 day, you can stand behind them because they might never change for a month and eventually for years. Okay, now let's go back on the, let's see. Okay, that's it. So let's get back there. I think that's it for the class. And like I used to say, I know that I'm not the only one who's here to give. So if you have any donation, feel free, let your heart talk. But I will appreciate that you subscribe, you make any comments. If I did something you need, if you think that I should talk about something or remove something, if there is terms that they're not using anymore, remember, I'm not financial analyst, I'm a physician, so maybe you help me find out. But feel free to comment and use the videos as any. You can download them, like I told you. You can save them and go over them as much as you want. So guys, that's it for, I forget what lesson I'm teaching, sorry. That's crazy, yeah? So that's it for lesson 9, and take care, bye.